Welcome to the Wall Street Blockchain Alliance Accounting Working Group podcast. I'm your host and chair of the AWG, Dr. Stein Smith. And here today for the March 2021 AWG podcast, I'm amped to have Pat White, the co-founder and CEO of BitWave. And now I want to toss it to Pat for a brief introduction of himself and his firm. Pat?
Hi, everybody. My name is Pat White. I'm the CEO of BitWave. I am a longtime crypto enthusiast, having gotten into crypto back in the day when you could mine it on your computer. And I always joke that at one point I bought a Bitcoin mining rig back when you could do that. And I wish I had just taken the money I spent on the Bitcoin mining rig and bought Bitcoin. It would be worth quite a bit more than a 10-year-old computer at this point. I started the company called BitWave. We are one of the leading tax and accounting solutions for businesses that use crypto. A good way to think about it is you have a few different categories of people out there using crypto. You have hedge funds that maybe buy a little bit of Bitcoin and just sort of sit on it for a long time. And then you have exchanges that are sort of holding it, but not maybe having to do much revenue recognition or things like that. We are really designed for businesses that day in, day out have to be using cryptocurrencies for their business. So whether that's they are paying contractors through it, they are receiving it as part of their their normal operating revenue, whatever it is, they are using cryptocurrency every single day, and they need to be basically accounting for that correctly, getting it onto their books, and then getting the taxes paid on it, because these are real businesses that have real obligations to be. It's if you're an individual investor, I wouldn't say you should, but certainly it's a lot easier to get away with crypto activity without the IRS coming down on you. As a business, it's just too risky. So businesses have really been at the forefront in some ways of being very good about taxes, very good about accounting practices, because they have a fiduciary duty to their stockholders and their legal authorities they're part of. So we specialize in basically a really robust set of tools for helping those types of businesses stay compliant and know how much money they're making, which is something everyone loves.
So yes, and so it's obviously critical that a firm is on top of how much they're earning. And obviously here on the podcast, we always encourage everyone, individuals or institutions, to be in full compliance with any tax laws.
100%. Yep.
And so to sort of piggyback on a point you actually raised, Pat, and you had mentioned that there was sort of this two-track ecosystem being built out between hedge funds and other institutions who are buying Bitcoin and other crypto assets as part of their hedging asset plan.
Sure.
And there are other individuals or firms that are trying to use crypto as a real part of their everyday business. Why do you think that there's this sort of two-track or two-tier model coming out to the marketplace?
Well, I think it's sort of two-sided here. The way I look at that part of the market is you have people that buy as an investment and hold, and then people that use. And this is probably well articulated in some of the more crypto communities as like the hodlers versus the people that really are spending it. And that even that
hodlers,
itself,
Pat, what does that mean, Pat?
hodlers are
for the audience.
people who are, you might have seen there's the world is becoming so funny, but you might have seen with the GameStop, there was all this vocabulary that came to the forefront of the universe based on this GameStop short squeeze that was happening. And one of the words that came out that everyone learned was diamond hands. So that's people that no matter what happens to a asset, to a stock in this case, they're going to hold on to it. The version of that for crypto, which has been around a lot longer, the term has been around a lot longer for cryptocurrencies than it has for stocks, is hodlers, HODL. It's based on a drunken post that someone made to one of the early Bitcoin talk forums, where they misspelled hold in their title. They said, "I'm not selling, I'm holding," but they said, "I'm hodling," and it's just become a common parlance. And so these are people that are really holding onto it for a long time, and take the investment and inflation hedge, properties of crypto very seriously. The other side of that are people who really are spending crypto on a day-to-day basis, and that it's interesting because within the crypto sphere itself, once you get like deeper into the communities, these are even different communities of people. The traditional Bitcoin community is very focused on this hodly mentality, really holding on to Bitcoin because they probably think the US dollar is going to crash. The other side of this is people that want to hold on to the original vision of the white paper. I always like talking about the white paper. If you haven't read it, it's a super interesting read. It's not too technical, but it has these two conflicting ideas in the white paper that I don't think we don't talk about enough in terms of cryptocurrency. The white paper is titled, Satoshi's white paper is titled Bitcoin, a peer-to-peer digital cash. But then inside of it, it details A, distrust in the banks, and B, it sets up a deflationary mechanism. The whole idea that Bitcoin will only ever have 21 million coins. And digital cash is necessarily in tension with this idea of a deflationary currency. There is no cash in the world. There is no fiat cash in the world that is deflationary. There are really good reasons for that because they want you to spend cash. And so you don't want to have a deflationary currency because deflationary currencies are things that you want to hold on to or assets. And so you have these two different mentalities of people who are just like holding on as either a hedge against market conditions or against the US dollar or from libertarian ideals. And then you have people who really want to see a peer-to-peer digital cash come out. And that's, the hedge funds tend to be more on the front side where they're really just looking for hedges against asset volatility in inflationary assets. But then the world that we're more and more in are people that are doing really cool stuff, whether it be with DeFi or with invoicing their customers or paying their employees, doing streaming payments to their employees. All of these are a world that is only enabled by this peer-to-peer cash mechanism where you are doing really powerful things with that. So those are the two different worlds that we certainly see out there.
Yeah. So it's almost as if it's a new technology tool, and it's a entirely new way of doing business. It's possibly and I hate to overuse this phrase, sort of a paradigm shifting tool.
Sure.
And it's awfully hard to try to forecast where it's ultimately going to play out.
Absolutely. And the paradigm shift really comes from the disintermediation aspect. Like more than anything, that's the most important thing to keep hammering on, especially 2020, 2021, is this idea of removing traditional gatekeepers from the equation. So whether the traditional gatekeeper is Lehman Brothers, well, that's a bad example. Sorry,
no, Pat, come on.
Goldman Sachs is Goldman Sachs, where the Goldman Sachs ends up being one of the few entry points to a number of different derivative exchanges and things like that the companies would get at. They're a gatekeeper to that. Removing Goldman Sachs from the equation and making it possible for businesses or individuals to go straight to a decentralized finance utility and create a CDO on top of Tesla or create an option chain themselves on top of Apple. These are really powerful mechanisms. It's all about removing the middlemen that were traditionally doing that service. And that goes with everything around. I mean, it goes with payroll, right? Being able to run your own payroll where you're streaming out to customers. I mean, that's a disintermediation of the traditional payroll providers. Then the ability to do invoicing is a disintermediation of the credit card companies. All of these things there's this 3% edge of friction built into almost every one of these transactions.
Yep.
That can be reclaimed by going peer-to-peer through some of these cryptocurrencies. Plus, just some people just can't get access to it. And now you can, because it's through DeFi you can get access to things you used to not be able to.
And obviously, there's a tremendous sort of outpouring of ideas and applications based on that very idea, being able to sort of decentralize and to try to cut out some of those incumbents, right? Be they banks, payment processors, governments, even all the rest. But I do want to pick your brain on this. And during the back half of 2020, and obviously during the first quarter of 2021, there has been quite a bit of institutional interest in Bitcoin and other cryptocurrencies, right? From Tesla to Square to PayPal, MasterCard, Visa, JP Morgan.
The rumor is Apple as well, though that's just a rumor.
Apple, yep, absolutely. And so as these large incumbent, very much part of that sort of centralized way of doing those transactions, payments, invoicing, get more and more involved in blockchain and crypto, how is that going to impact this whole idea on DeFi, DEXs, and other applications, NFTs? How are these big institutional players coming in going to influence that?
It's such a good question. And I think it all comes down to why they are getting in. So
Hmm.
I look at someone like Square getting into crypto, and I don't, or MicroStrategy is a great example.
Sure.
I don't attribute them to they aren't looking at use cases for crypto. They are looking at crypto as a hedge. And also a
Hmm.
little bit because Jack Dorsey is just, he's kind of out there, and this is the way he's thinking about the world. So for them, I see them as they almost are acting like hedge funds in that sense. They want to hedge their exposure to USD. They maybe have more libertarian leaning founders who are more nervous about the current economic, like with the US about to print $2 trillion. There are a lot of people who lean more libertarian who are a little bit nervous about that. So that's kind of when I look
Hmm.
at MicroStrategy, Square, that's what I think about them. When I look at Tesla or Apple though, I see a different use case. So Tesla already said that they want to accept payment in cryptocurrency
Hmm.
for their cars. That's awesome. So that's a I think that's a bit of a what's the right word? Like maybe a little bit of a PR spin. Like maybe they don't
Sure.
really care that much. But if you dig into it, both Tesla and Apple have these massive supply chains that cross multiple continents. And so that's where this gets really exciting because they are paying a lot of money to all of the banks and Forex people between point A and point B to pay their upstream suppliers. Apple, especially, I mean, Apple is one of the most complicated logistical supply chain setups in the world. And this is not me pitching the blockchain for supply chain. This is me pitching cryptocurrencies as a mechanism for paying up your supply chain when you have people that are in 20 different countries with 20 different regulatory frameworks and 20 different banking systems you have to work with. So if they could actually cut out what probably ends up being 5 to 10% friction in the supply chain
Hmm.
world, if they can start
Hmm.
cutting that out, that is real money for a company like Apple. If they can start paying something like Ethereum or Bitcoin to their upstream providers, they're not having exposure. They're not having to change their exposure to the local currencies or USD, whatever it is. Plus, they're able to do it a lot faster without the ability to do chargebacks and all these kinds of things. I mean, that to me, once they start including their ecosystems, that's a phenomenal use case for crypto. That's where I see a lot of those companies going.
Interesting points all around for sure. And a question that I'm starting to hear more and more sort of on the front burner is, okay, fine. So we have all of this upside, all of this potential, all of these great moves, be it at firms or as part of their supply chains. But how do we do the accounting for all of this, right? Because we're talking about asset valuations, using it as a medium of doing business as a real currency alternative, but there is no crypto specific accounting guidance, and so how is that complicating issues on the ground, right?
Yeah.
Well, obviously, right, duh, but how
Horrifically.
is it?
Well,
What do you
it's
see in
funny.
that?
Yeah, it's so funny. Well, so the one part is like, I feel like everyone's when they first sniff at this, they're like, oh, we're like, people are doing this for tax avoidance. And I don't know if I want to have a tax and accounting solution, yada, yada, yada. But it's funny is I always
Mhm.
have to remind people that accountants, they don't just tell you to pay your taxes. Accountants tell you how much money you're making. They tell you they give you good news also, not just bad news. um,
Absolutely right. We're the best.
yeah, we're the best. And so it's kind of part of the problem here is that you're not just doing this because the tax man cometh. You're doing this because you genuinely need to understand how your business is changing based on this crypto flows. So it's
Mhm.
incredibly difficult. I mean, essentially, in the traditional accounting world, especially at the line level, the people who are doing the bookkeeping
Mhm.
tend to be very segregated between the bookkeepers and the tax people, right? You don't
Sure.
tend to have the bookkeepers be really, really robustly knowledgeable about tax. They certainly can be, but like
Mhm.
when you're hiring a bookkeeper, the first question you ask isn't about tax. And the same thing when you hire a tax person, the first question you ask isn't about bookkeeping. Crypto is a
Mhm.
little bit different because essentially every action, every transaction that you execute has a tax implication when you're crypto. And that goes for every single coin that's out there. I mean, even stable coins like USDC and
Mhm.
Tether are
Yep.
treated, per the US government and GAAP guidelines, are treated like a asset that needs to be tracked for taxes. And so every single operation you do, you are both, you are accounting for it, you are setting a cost basis, and then you are potentially setting a gain or loss based on that. So that makes tools like ours even more important because it becomes very difficult to track all that. So where we really shine Thank you for the excellent setup, of course, is, we have, it's in the same, we have like one UI where you go to recognize a transaction, and in the same UI that you are essentially going to reconcile it to get it onto your books. Like, let's say it's a revenue transaction. Someone paid you, 1 Bitcoin for some consulting work. You're going to need to recognize the fair market value at the point in time you receive that as income. But then you also need to lock the fair market value cost basis as the cost basis, so that when you dispose of that Bitcoin, you are recognizing your gain or loss. And so like our UI, for instance, it includes tax and accounting essentially in the same click, because that's the best way to sort of do this work, is to make it one part of the same workflow. And then, of course, this is where it gets really messy, is there's really very, I wouldn't even say mixed. The guidance that has come from the Big Four about GAAP treatment for digital assets is very counterintuitive to most people who are deep in digital assets. Now, it's good for us is that we don't actually have a lot of customers that are strict about GAAP accounting. They are a little bit more lenient to use other accounting methods, either based on their jurisdiction or based on the size of the company or not being public or whatever it is. But the Big Four have sort of kept with this intangible asset treatment, where essentially you only ever mark down your assets until you sell them. You never mark their value up. But what ends up happening is, I love pointing this example of Tesla. So in 2020, Tesla bought $1.5 billion of Bitcoin. From that $1.5 billion, from the price they bought it out, according to the filing, the 10K they did on it, they made $750 billion. That was sort of their unrealized gains on that value, the value going up. In that same period, they made $730 billion on selling cars. So they have more value gain in their business from the Bitcoin than from the thing that their business is supposed to be doing.
That's incredible.
It is nuts.
That's totally like out of this world, and I think really highlights the importance of trying to get some crypto specific information out to the marketplace.
100%.
But so outside of those rather to us obvious issues, right, where the balance sheets and the income statements just aren't reflecting economic actualities, what are some of the other issues in terms of trying to implement, trying to onboard, trying to actually get a company up and running to take crypto as payment? What are some of those issues, Pat?
Well, the first issue of all of this is that most people are not experts in this. And this stuff is complicated. I mean, it's so funny. Like, even the most simple thing of saying, hey, what's your crypto address that I can send this to you, is in fact it's complicated. Like, it's so silly. But even that simple thing, because with Bitcoin, you might use a Trezor that uses a hierarchical deterministic wallet. So in fact, with Bitcoin, very often you'll have multiple addresses that all feed into the same wallet. Whereas with Ethereum, you just have one address. And then in EOS world, they call it an account instead of an address. And in Dash, it's more like Bitcoin. So it's like, even the most basic thing of like trying to teach someone what a crypto address is not simple. It is incredibly complicated. And that comes into like how you're doing accounting for it. So with a tool like ours, you have this place where you have to go and put your Bitcoin address in. But like, do you know, if you are a new bookkeeper, if you're new to the crypto space, do you know to put your XPub in there? Do you know to put in a direct address? Are you going to try to put in every single address and change address? Do you know what a change address is? I know I'm just like spewing words at this point, but it's like, this is the very first thing. This isn't the second or third thing. The very first thing you need to do in crypto is already incredibly complicated. And so to that extent, I'd say one of the biggest things is just the training, and how, when we onboard new customers, we spend 4, 5, 6 hours with their bookkeepers, operations people, CFOs, just explaining a lot of the stuff. And this doesn't even get to like DeFi. Like, don't even get me started about DeFi, because that's a whole nother set of issues. But it's just purely explaining like, hey, here's what an address is. Here's how it's different between Bitcoin and Ethereum. Here's how you're going to kind of account for it. Here's why when you send money from your exchange to a wallet, the times don't always match up, and you might have to look at the times there and do a little bit different treat. There's just so much to explain on that side, and that's just getting them even started. It is really tricky.
And so all of that really sort of highlights a common theme that I know I've been hearing quite a bit. Education, training, and just trying to get the field and bookkeepers, tax folks working in finance, econ, up to speed. Right.
Yep, 100%. And just, I mean, ultimately, I think that what you're going to see for the next couple of years, and what we already see, is that we're starting to price in in the same way that like QuickBooks does like they have their QuickBooks experts. We are doing something very, very similar, which is we have our BitWave experts who are, CPAs or bookkeepers that we work with, that we've spent hours with training what crypto is, who then when we sell to a customer, we often will include some amount of hours for this expert time, which is essentially someone that they can tap and they can ask these questions to. And I think that's the model we're going to see. We're going to have to see a core group of really crypto savvy, CPAs, tax people, bookkeepers that come out that end up being the leaning on resource for all of these new companies that are going to be getting into crypto and digital assets over the next few years.
And I think that there's going to be quite a huge market for that. And to sort of wrap up right here, Pat, and I always try to put everyone who's on the podcast with me on the hot seat at the very end when they're easing into the end of it. I always hit them with a hot seat question. So I'm going to ask you in terms of sort of obviously sort of the renewed interest in crypto blockchain applications has been driven in at least some part by the increase in the actual prices. So if I had to ask you to put a hard target on Bitcoin year-end 2021 price, what are you thinking? Don't be Googling it now either.
I think we hit 100K this year.
100K. All right. So you heard it here first. All right. On the March ADBG podcast, Pat White said 100K Bitcoin price.
Yeah. Let's get me back January 2022 and either make fun of or applaud my prediction.
Absolutely, Pat. You got it. And Pat White, thank you again for joining us on the March podcast.
Thanks so much, Sean.